Buying a home often comes with a mortgage. This is a significant financial commitment that most people will encounter at some point in their lives. Understanding the intricacies of mortgages can help you make more informed decisions and potentially save a lot of money in the long run. Mortgages come with interest rates, which are essentially the cost of borrowing money from a lender. These rates can vary widely based on a number of factors, including your credit score, the size of your down payment, and the overall economic climate. And you can sometimes get a lower interest rate by improving your credit score or by making a larger down payment. However, there's another way to potentially lower your interest rate that many people aren't aware of. This is where mortgage points come in. Mortgage points, also known as discount points, are a type of prepaid interest that you can pay upfront to reduce the interest rate on your mortgage. Mortgage points, also known as discount points, are upfront fees you pay to your lender at closing. These points are essentially a way to buy down your interest rate, which can lead to significant savings over the life of your loan. Think of it like this: you're essentially prepaying a portion of your interest to secure a lower rate for the life of your loan. This can be particularly beneficial if you plan to stay in your home for a long time, as the savings from the lower interest rate can add up over the years. Each point typically costs 1% of your loan amount. So if you have a $300,000 mortgage, 1 point would cost you $3,000. This might seem like a lot of money up front, but the long-term savings can be substantial. For example, on a $300,000 mortgage, 1 point would cost $3,000. This upfront cost can lower your interest rate by a certain percentage, which can save you money on your monthly payments and over the life of the loan. Why would you pay more upfront? The answer lies in the potential savings. By paying for points, you can reduce your monthly mortgage payments, which can make your home more affordable in the long run, because a lower interest rate can save you significant money over the life of your loan. Even a small reduction in your interest rate can lead to thousands of dollars in savings over the years. It's a trade-off immediate cost for long-term savings. By paying more upfront, you can reduce your overall interest payments, which can be a smart financial move if you plan to stay in your home for a long time. But how do you know if paying for points is the right move for you? This is where a break-even analysis comes in handy. A break-even analysis helps you determine how long it will take for the savings from the lower interest rate to offset the upfront cost of the points. That's where the break-even analysis comes in. This analysis takes into account the cost of the points and the amount you'll save each month with the lower interest rate. By calculating how long it will take to recoup the cost of the points, you can make a more informed decision. It helps you determine when you'll start reaping the benefits of a lower rate. If you plan to stay in your home beyond the break-even point, paying for points can be a wise investment. However, if you plan to sell or refinance before reaching the break-even point, it might not be worth the upfront cost. Let's break down the cost of mortgage points. As mentioned earlier, each point typically equals 1% of your total loan amount. For a $250,000 mortgage, 1 point would cost you $2,500. 2 points would be $5,000, and so on. This upfront cost is added to your closing costs. These are already substantial expenses associated with buying a home. Understanding the immediate financial impact of points is crucial when deciding if they fit your budget. Now, let's explore the potential savings of a lower interest rate. Lower interest rates can significantly impact your financial health, especially when it comes to long-term commitments like mortgages. By understanding how these rates work, you can make more informed decisions that could save you thousands of dollars over the life of your loan. Assume you have 2 mortgage options. Option 1 offers a 4% interest rate with no points purchased. And this is a straightforward option where you pay a fixed rate over the term of your mortgage. Option 2, on the other hand, offers a 3.75% interest rate, but it comes with the cost of purchasing 1 point. Mortgage points are fees paid directly to the lender at closing in exchange for a reduced interest rate. Each point typically costs 1% of your total loan amount. With a lower interest rate, your monthly mortgage payment will be lower. This reduction can make a significant difference in your monthly budget, freeing up funds for other expenses or savings. This reduction in monthly payments represents your savings over time. These savings can accumulate, providing you with more financial flexibility and security. To calculate this, you can use online mortgage calculators or consult with your lender. And these tools allow you to input different interest rates and loan terms to see how they affect your monthly payments and overall loan cost. These tools will provide a precise breakdown of your monthly payments based on different interest rates. They can also show you the total interest paid over the life of the loan, helping you understand the long-term impact of your mortgage choices. Seeing these potential savings can be enticing. The idea of paying less each month and saving money over time is appealing to many homeowners. However, the key is to figure out how long it takes to recoup the upfront cost of the points. This involves calculating the break-even point, which is the time it takes for the monthly savings to equal the cost of the points. And this is where the break-even point comes into play. By understanding this concept, you can determine whether paying for points is a good financial decision for your specific situation. It's important to consider how long you plan to stay in the home and whether the upfront cost will be worth the long-term savings. Section 4, reaching the break-even point. When paying points pays off, the break-even point is the time it takes for your monthly savings to equal the upfront cost of the points. To calculate this, divide the total cost of the points by your monthly savings. For example, if you paid $2,500 for points and saved $50 per month, your break-even point would be 50 months. This means it would take you a little over 4 years to recoup the initial cost of the points. After that, you're essentially pocketing pure savings each month. Knowing your break-even point is crucial for determining if paying for points aligns with your financial goals and timeline. Section 5, example time. Putting the calculations into practice. This is where all the theory and numbers we've discussed come together to form a clear picture of your financial future. Let's illustrate this with a real-life scenario. Imagine you're in the market for new home market and you have found the perfect place. It's a big decision, and understanding the financial implications is crucial. Suppose you're considering a $400,000 mortgage. You have two options to choose from, each with its own set of benefits and costs. Option A offers a 4.25% interest rate with no points. This means you won't have to pay any additional upfront fees to secure this rate. Option B, on the other hand, provides a slightly lower interest rate of 4.0%. However, this comes at a cost of 1 point, which translates to $4,000 upfront. After using a mortgage calculator, you determine that option B would save you $75 per month on your mortgage payments. This might seem like a small amount, but over time it adds up. To calculate the break-even point, you need to divide the cost of the point, which is $4,000, by the monthly savings of $75. Doing the math, 4,000 divided by 75 equals 53.33 months. This means it would take approximately 53 months, or a little over 4 years, to reach the break-even point. This is the point at which the savings from the lower interest rate start to outweigh the initial cost of the point. After that, you'll enjoy pure savings each month. This extra money can be used for other financial goals, such as paying off other debts, investing, or even saving for a rainy day. Understanding these calculations helps you make informed decisions that align with your long-term financial goals. It's important to consider how long you plan to stay in the home. If you plan to move before reaching the break-even point, paying for points might not be the best option. However, if you plan to stay for a longer period, the savings can be substantial. Additionally, think about your overall financial situation. Do you have the upfront cash to pay for the points without straining your budget? If so, it might be worth the investment. If not, the ba sa the higher horsers inline sa indicasa farivis highest rate with no points might be a safer choice. Ultimately, the decision comes down to your personal financial situation and goals. By putting these calculations into practice, you can make a more informed choice that benefits you in the long run. Remember, every financial decision you make today impacts your future. Take the time to understand your options, run the numbers, and choose the path that aligns with your financial goals and lifestyle. With the right knowledge and tools, you can navigate the complexities of mortgages and make decisions that set you up for financial success. Happy calculating.